Most people believe investment success comes from choosing the right asset, the right stock, the right fund, the right moment. That belief is comforting because it suggests that intelligence, research, or access will save you. In reality, those things matter far less than how you behave once money is at risk. Behavior shows up after the decision, not before it. Anyone can buy a good asset. Very few people can hold it when it becomes uncomfortable. Markets are designed to test patience. Prices move every day, often for reasons that have nothing to do with long-term value. Headlines amplify fear and confidence at exactly the wrong moments. When prices rise, people feel smart and take on more risk than they planned. When prices fall, they feel foolish and look for exits. The asset didn't change. The behavior did. This is why two people can own the same investment and end up with completely different results. One holds through volatility, reinvests, and lets time do the work. The other reacts, sells, waits for clarity, and buys back higher and never returns at all. The difference in outcome is not knowledge. It is discipline. Another behavioral trap is overconfidence. Early success convinces people they have skill rather than luck. They concentrate positions, trade more often, and take risks that only look reasonable in good markets. When conditions change, those risks don't quietly reverse. They collapse. The problem wasn't the asset. It was the assumption that the investor was in control. Fear works the same way in reverse. After losses, people avoid risk entirely. They stay in cash waiting for certainty that never comes. Inflation quietly erodes purchasing power while they feel safe. Again, the damage comes from behavior, not from a poor menu of options. Consistency matters more than brilliance. A simple, diversified investment held for decades will outperform most sophisticated strategies if the investor actually sticks with it. The challenge is not understanding this intellectually. The challenge is living with it emotionally. Boring strategies feel irresponsible during bubbles and naive during crashes. That discomfort pushes people to abandon the very approach that works. Time is another place where behavior dominates. Compounding rewards patience, but impatience is natural. People want results that validate their decision quickly. When they don't see them, they change course. Every unnecessary change resets the clock. The cost is invisible but enormous. Even fees and taxes are behavioral issues at their core. Chasing performance leads to higher turnover and higher costs. These don't show up as dramatic losses. They show up as quietly lower outcomes over decades. The investor feels active and involved, but the account grows slower than it should. The hardest truth is that markets do not require you to be exceptional. They require you to be reasonable for a very long time. That means accepting periods of underperformance, ignoring noise, and resisting the urge to act when doing nothing is the correct choice. Asset selection gets attention because it's measurable and discussable. Behavior is ignored because it's uncomfortable and personal. But behavior is where results are actually decided. The investor who wins is not the one who always picks correctly. It's the one who makes fewer emotional mistakes and gives compounding enough time to work. Complexity in investing is often mistaken for sophistication. More moving parts, more strategies, more opinions feel like progress. In reality, complexity usually increases the number of ways a plan can fail. Simplicity, when combined with diversification, reduces the need for constant decisions and protects investors from their own worst instincts. The financial system already contains enough uncertainty. Economic cycles, interest rates, geopolitics, and technology shift in ways no one can consistently predict. Adding layers of complexity on top of that does not create control. It creates fragility. When a complex strategy breaks, it often breaks all at once, and the investor usually doesn't understand why until after the damage is done. Diversification works because it accepts uncertainty instead of fighting it. By spreading capital across many businesses, sectors, or regions, you stop relying on a single outcome being right. You are not betting on one forecast, one manager, or one idea. You are aligning yourself with the broader system of economic growth, which has historically been far more resilient than any individual component. Simple, diversified approaches also reduce behavioral errors. When a portfolio is easy to understand, it is easier to hold. Investors are less likely to panic when one part underperforms because no single position dominates the outcome. Losses feel manageable rather than catastrophic. That emotional stability is not a soft benefit. It directly affects long-term returns. Complex strategies often promise higher performance through precision. In practice, they require perfect execution and constant monitoring. They depend on timing, correlations holding, or assumptions remaining true. Markets rarely cooperate. When conditions change, complexity magnifies mistakes. What looked diversified on paper becomes concentrated in reality, often in risks the investor never intended to take. Another overlooked advantage of simplicity is cost. Complex products tend to come with higher fees, hidden expenses, and tax inefficiencies. Each layer takes a small percentage, and over time those small percentages compound against you. The return gap between and a low cost, a diversified portfolio and a high cost, complex one can be enormous over decades, even if the gross performance looks similar in the short term. Simplicity also scales better over time. A strategy that works with $10,000 should still work with $100,000 or $1 million. Many complex approaches break as capital grows or as market conditions shift. Simple diversified strategies do not rely on special access or narrow opportunities. They are durable. People are drawn to complexity because it offers the illusion of control and the promise of being smarter than the market. But markets are competitive systems. Any edge that is real is quickly exploited and disappears. What remains reliable is participation, patience, and risk management. Diversification does not mean average results. It means avoiding disastrous ones. By limiting downside, you get compounding the uninterrupted time it needs to work. Avoiding large mistakes matters more than capturing every opportunity. In the end, simplicity is not about settling for less. It is about removing unnecessary obstacles between you and long-term results. Diversification is not about fear. It is about respecting how unpredictable the future actually is. The investors who succeed are rarely the most complex thinkers. They are the ones who choose approaches they can understand, afford, and stick with when the environment inevitably changes. Long-term discipline is rare precisely because it is simple to understand and difficult to live with. Most people know, at least intellectually, that markets reward patience. Yet very few investors actually behave in a patient way over long periods of time. This gap between knowledge and action is where discipline becomes a true competitive advantage. Markets constantly create reasons to abandon long-term thinking. Short-term performance is visible, measurable, and emotionally charged. News cycles are designed to provoke urgency. Price movements suggest that something must be done, even when the rational response is to do nothing. Discipline is the ability to resist that pressure without needing constant reassurance. Compounding only works when it is left undisturbed. Every time capital is moved unnecessarily, the process resets. Taxes, fees, and timing errors quietly interrupt growth. These costs are rarely felt in a single moment, which makes them easy to ignore. Over decades, they become the difference between acceptable results and exceptional ones. Discipline protects compounding by minimizing these interruptions. Another reason discipline matters is that markets do not reward consistency evenly. There are long periods where disciplined investors appear wrong. Simple strategies underperform more exciting ones during speculative phases. Staying disciplined in those moments feels uncomfortable and isolating. The temptation to chase what is working becomes intense. Giving in often feels justified, but it usually occurs near the peak of enthusiasm, not the beginning. Discipline also means accepting uncertainty without demanding constant validation. Long-term investors operate without knowing how the next year or even the next 5 years will unfold. They commit to a process rather than a prediction. This is difficult because humans are wired to seek immediate feedback. Markets provide feedback, but it is often misleading in the short run. The ability to stay invested during downturns is one of the clearest expressions of discipline. When prices fall, the future feels more uncertain, not less. Selling in those moments is emotionally understandable and financially damaging. Discipline does not eliminate fear, but it prevents fear from dictating decisions. It allows investors to continue following a plan even when confidence is low. Repetition is another underrated aspect of discipline. Regular investing, rebalancing when necessary, and maintaining allocation over time create outcomes that no single decision can match. None of these actions feel significant on their own. Together, over many years, they become powerful. The advantage comes not from intensity, but from consistency. Discipline also limits regret. Investors who follow a clear long-term plan are less likely to second-guess every outcome. They understand that no strategy avoids all losses. What discipline offers is coherence. Decisions make sense in context, even when results are temporarily disappointing in competitive markets. Any ADV advantage based on information or speed is fleeting. What cannot be easily copied is the willingness to stay calm, patient, and consistent while others react emotionally. That is why discipline compounds into an edge. Over time, disciplined investors are not necessarily smarter or more informed. They're simply more durable. They remain in the game long enough for probability to work in their favor. And in investing, durability is everything.